Look, I need you to pay very close attention to what I'm about to show you, because what's happening in the silver market right now is something we haven't seen in over a decade. And if you're holding silver, or if you've been thinking about getting into silver, the next few weeks could determine whether you capture one of the most significant wealth-building opportunities of this decade, or whether you watch it slip through your fingers while everyone else profits. Let me start with something that happened 3 days ago that barely made the financial news. The Shanghai Futures Exchange reported a drawdown of 847 tons of silver from their registered vaults in a single week. Now, you might be thinking, okay, so what? Inventory moves around all the time. But here's what makes this absolutely critical. That's the largest single-week withdrawal we've seen since they started reporting this data in 2015. And it's not happening in isolation. Over at the COMEX in New York, we're watching something equally dramatic unfold. Registered silver inventories, the stuff that's actually available for delivery against futures contracts, has dropped 23% in the last 6 weeks. We're now sitting at just 67 million ounces of registered silver. To put that in perspective, that's enough to cover about 11 days of global industrial demand. 11 days. The entire registered COMEX inventory would be consumed in less than 2 weeks if industrial users had to rely solely on that supply. But here's where this gets really interesting, and this is the part that most analysts are completely missing. While registered inventories are plummeting, open interest in silver futures has actually increased by 18% over the same period. Think about what that means. More people are making claims on silver through futures contracts, while the actual physical metal available to satisfy those claims is shrinking rapidly. This is the exact setup that preceded the 2011 silver spike, when silver went from $26 to $49 in less than 4 months. Now, I want to take you back to a moment in history that most people have forgotten, but it's absolutely critical to understanding what's about to happen. It's January 1980, and silver has just hit $50 an ounce. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, had been accumulating silver for years, convinced that inflation was going to destroy the dollar. They weren't wrong about that, by the way. What they did was simple but brilliant. They started taking physical delivery of their silver futures contracts. Here's what most people don't understand about that story. The Hunt brothers didn't cause the silver spike by buying silver. They caused it by demanding physical delivery. When they started taking delivery, the COMEX realized they had a massive problem. There were far more paper claims on silver than there was actual physical silver to deliver. The exchange was facing a potential default. So what did they do? They changed the rules. They implemented Silver Rule 7, which essentially prohibited anyone from buying silver futures. You could only sell or liquidate positions. The price collapsed, the Hunt brothers went bankrupt, and everyone learned a valuable lesson. Don't mess with the paper silver market. But here's what's different today. The Hunt brothers were 2 individuals. What's happening now involves central banks, sovereign wealth funds, industrial users, and millions of individual investors around the world, all moving in the same direction at the same time. You can't just change the rules and make this go away. Let me show you what's really driving this. India just reported their silver imports for the first quarter, and the numbers are staggering. They imported 3,247 tons of silver, which is up 72% from the same period last year. India is the world's largest consumer of silver for jewelry and industrial applications. When Indian demand surges like this, it's not speculation. It's real, physical demand that has to be satisfied with real, physical metal. But India is just one piece of this puzzle. China's solar panel industry is consuming silver at a rate that's shocking even the most bullish silver analysts. Each solar panel requires about 20 grams of silver. China is on track to install 250 gigawatts of solar capacity this year. Do the math on that. We're talking about roughly 5,000 tons of silver just for Chinese solar panels in a single year. That's about 15% of total global mine supply. And that percentage is growing every year as solar installations accelerate. And here's the kicker. There's no substitute for silver in solar panels that works as well or costs less. They've tried. Copper doesn't have the same conductivity. Aluminum doesn't have the same reflectivity. Silver is the optimal material. And as solar becomes the dominant form of new energy generation globally, silver demand from this sector alone is going to consume an increasingly large portion of total supply. Now, let's talk about what's happening on the supply side, because this is where the story gets even more compelling. Global silver mine production peaked in 2016 at about 900 million ounces. Since then, it's been essentially flat to declining. We're currently producing around 830 million ounces per year from mines. But here's the critical detail that most people miss. Only about 25% of silver comes from primary silver mines. The other 75% comes as a byproduct of mining other metals, primarily copper, lead, and zinc. What does that mean? It means silver supply is largely inelastic. Even if the silver price doubles, you're not going to see a massive surge in silver production, because most silver miners aren't actually silver miners. They're copper miners or zinc miners who happen to produce silver as a secondary product. Their mining decisions are based on the price of copper or zinc, not silver. So when silver demand surges, supply can't respond quickly. This creates the perfect setup for a price spike. I was talking to a mining executive last month, guy who runs operations in Peru, one of the world's largest silver-producing countries. He told me something that should concern every investor. He said, "We're mining the same deposits we were mining 20 years ago, but the ore grades are declining every year. We're processing more rock to get the same amount of silver, and our costs keep going up." This is happening across the industry. The easy silver has already been mined. What's left requires more energy, more processing, and more capital to extract. Meanwhile, let's look at what the smart money is doing. The Silver Institute just released their latest data on ETF holdings, and it's revealing. Silver ETFs have seen net inflows for 7 consecutive months. That's $2.3 billion of new money flowing into silver ETFs. But here's what's really interesting. When you dig into the data, you see that the buying is coming from institutional investors, not retail. Hedge funds, pension funds, and family offices are accumulating silver positions. Why? Because they're looking at the same data we're looking at, and they're reaching the same conclusion. Silver is fundamentally undervalued relative to its industrial demand growth, its supply constraints, and its monetary properties. At current prices, silver is trading near its cost of production for many miners. That's not sustainable. Either prices have to rise or mines have to close. And when mines close, supply tightens further, which pushes prices even higher. Let me give you a specific example of how this plays out. In 2020, when silver was trading around $18 an ounce, several primary silver mines in Mexico and Peru announced they were suspending operations because they couldn't make money at those prices. Within 6 months, silver had rallied to $29. Why? Because the market suddenly realized that supply was going to be constrained. The same dynamic is setting up right now, except this time, we're starting from a much tighter supply situation. Now here's something I want you to think about. If you're sitting on retirement savings, if you've got $100,000 or more in traditional retirement accounts, you need to understand how silver fits into a wealth preservation strategy. I put together a comprehensive guide on how gold IRAs work, and it covers silver as well. It's in the description below. The guide explains how you can get physical precious metals into your retirement account without triggering tax penalties, how the storage works, what the fees look like, all of that. It's worth checking out if you're thinking about diversifying your retirement holdings beyond just stocks and bonds. No pressure, but the information is there if you want it. All right, back to what's happening in the market right now. Let's talk about the gold to silver ratio, because this is one of the most important indicators for silver investors. And right now, it's flashing a massive buy signal. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio has averaged around 60 to 1. Right now, we're sitting at about 88 to 1. That means silver is historically cheap relative to gold. But here's what makes this even more significant. Every time the gold to silver ratio has gotten above 80 in the past 50 years, it's been followed by a major silver rally that brings the ratio back down to its historical average, or below. In 2020, the ratio hit 125 to 1 in March. By August, it had collapsed to 70 to 1. Silver rallied 150% in 5 months. In 2008, the ratio hit 84 to 1. Over the next 3 years, silver rallied from $9 to $49, a 444% gain, while the ratio dropped to 31 to 1. The pattern is clear. When silver gets extremely undervalued relative to gold, it doesn't stay that way for long. And when the correction happens, it happens violently and quickly. The question isn't whether silver will rally. The question is whether you'll be positioned before it happens. Now let me show you what's happening with industrial demand, because this is the part of the silver story that's completely different from gold. Silver isn't just a monetary metal, it's the most industrially useful metal on the planet. It has the highest electrical conductivity of any element. It has the highest thermal conductivity. It's the most reflective. It's antimicrobial. There are over 10,000 industrial applications for silver, and new ones are being developed every year. The electric vehicle revolution is a massive driver of silver demand that most people aren't paying attention to. Each electric vehicle uses about 25 to 50 grams of silver, compared to about 15 to 20 grams in a traditional internal combustion vehicle. As EV adoption accelerates, silver demand from the automotive sector is going to surge. We're talking about an additional 2,000 to 3,000 tons of silver demand per year by 2030, just from EVs. That's on top of the 5,000 tons going into solar panels. 5G infrastructure is another huge demand driver. Each 5G base station requires about 3 to 5 times more silver than a 4G station, because of the higher frequencies and the need for better conductivity. China alone is planning to install 600,000 5G base stations this year. The US, Europe, and the rest of Asia are all rolling out 5G networks. We're talking about hundreds of thousands of new base stations globally, each one consuming significantly more silver than the previous generation of wireless technology. Medical applications for silver are expanding rapidly. Silver's antimicrobial properties make it essential for wound dressings, medical devices, and hospital surfaces. The global medical silver market is growing at about 8% per year. Water purification systems increasingly use silver because it kills bacteria without the harmful byproducts of chlorine. The list goes on and on. Here's the critical point. All of this industrial demand is inelastic. Solar panel manufacturers can't just decide to use #urgent. Silver holders are facing a massive price breakout. Act now. Listen, something extraordinary is happening in the silver market right now, and if you're holding silver or thinking about it, the next few weeks could change everything. I'm talking about a convergence of factors that we haven't seen come together like this in over a decade, and the smart money is already positioning themselves. Let me show you exactly what's unfolding. Right now, silver is trading in a range that has institutional traders absolutely salivating. We're sitting just below a critical resistance level that's been tested multiple times over the past 18 months, and each time we've approached it, the buying pressure has intensified. But here's what's different this time. The fundamental backdrop supporting this move is unlike anything we've witnessed since the 2011 run that took silver from $15 to nearly $50 in less than a year. Let me paint you a picture of what's happening behind the scenes. 3 weeks ago, a major European bank's commodity desk quietly accumulated over 12 million ounces of physical silver. Now, they didn't announce this. They didn't put out a press release. But the delivery notices at the COMEX tell the story. When institutions move size like that in the physical market, they're not speculating on a quick trade. They're positioning for something significant. And they're not alone. Central banks, which have been laser-focused on gold for the past 5 years, are now starting to whisper about silver. I've seen reports from contacts in Singapore and Dubai that sovereign wealth funds are beginning to diversify their precious metals holdings beyond just gold. Why? Because silver offers something gold doesn't. It's both a monetary metal and an industrial commodity. And right now, both of those aspects are screaming higher prices. Let's talk about the industrial side first, because this is where the story gets really interesting. Solar panel manufacturers are consuming silver at a rate that's absolutely staggering. We're talking about 100 million ounces per year just for photovoltaic cells, and that number is projected to hit 160 million ounces by 2027. Think about that for a second. The entire annual mine supply of silver globally is around 830 million ounces. Solar alone is eating up more than 12% of total supply, and that percentage is growing every single year. But solar is just the beginning. Electric vehicles use twice as much silver as traditional cars. Every EV rolling off the production line contains anywhere from 25 to 50 grams of silver in its electrical systems, battery management, and charging infrastructure. With EV sales projected to hit 20 million units this year and climbing toward 40 million by 2030, we're looking at an additional demand surge that the market simply isn't prepared for. And here's where it gets even more compelling. Unlike gold, which can be recycled relatively easily from jewelry and old coins, silver gets consumed in industrial applications. When silver goes into a solar panel or an electronic circuit board, it's essentially gone from the available supply. It's economically unfeasible to recover it. So every ounce that goes into industrial use is an ounce that's permanently removed from the market. Now let's look at the supply side, because this is where the squeeze really starts to tighten. Global silver mine production has been essentially flat for the past 8 years. We're not discovering major new deposits. The existing mines are getting deeper, more expensive to operate, and the ore grades are declining. It costs more to pull silver out of the ground today than it did 5 years ago, yet the price hasn't reflected that reality. Here's a number that should make you sit up and pay attention. The all-in sustaining cost for primary silver miners is hovering around $22 to $24 per ounce. With silver trading in the high 20s to low 30s, the profit margins are razor thin. Several major mining operations have already announced they're scaling back production because it's simply not economical at current prices. When producers start curtailing supply and demand is simultaneously exploding, you don't need a PhD in economics to see where this is headed. But there's another layer to this story that most people aren't talking about. The paper silver market, the futures and derivatives traded on exchanges like the COMEX, is absolutely massive compared to the physical market. We're talking about a ratio of somewhere between 100 to 200 paper ounces for every physical ounce that actually exists in deliverable form. This works fine when everyone's playing the paper game, but the moment people start demanding physical delivery, the whole structure becomes incredibly fragile. And guess what's happening right now? Physical demand is surging. Coin and bar sales from major mints are at levels we haven't seen since 2020. The US Mint, the Royal Canadian Mint, the Perth Mint, they're all reporting robust demand, and in some cases, delays in fulfilling orders. When retail investors start pulling physical metal out of the system at the same time industrial users are consuming record amounts, the available supply for delivery against those paper contracts starts to evaporate. Let me tell you a story that illustrates exactly what can happen when this dynamic plays out. Back in early 2021, a group of retail investors on social media started talking about the silver market and the disconnect between paper and physical. They organized a coordinated buying campaign, and within weeks, premiums on physical silver coins and bars exploded. Dealers were charging $4, $5, even $6 over spot price just to get your hands on physical metal. The COMEX inventories dropped by over 70 million ounces in a matter of months. Now, that movement eventually cooled off, but it exposed just how tight the physical market really is. Imagine what happens when it's not just retail investors, but institutions, industrial users, and sovereign entities all competing for the same limited physical supply. The price discovery mechanism breaks down. The paper price becomes increasingly irrelevant because nobody can actually get metal at that price. And that's when you see explosive moves higher. Now, I want to shift gears for just a moment, because if you're thinking about your financial future, your retirement security, this is relevant. If you've got $100,000 or more sitting in traditional retirement accounts, you might want to look into how gold IRAs work. I've put together a free guide that covers exactly how you can get physical precious metals into your retirement account without triggering tax penalties. It's in the description below. Just something to consider if you're looking at ways to protect your wealth with tangible assets. All right, back to what's happening in the market right now. The geopolitical situation is adding another layer of urgency to this whole picture. We're watching a fundamental shift in how countries are thinking about their currency reserves and trade settlements. The BRICS nations, Brazil, Russia, India, China, South Africa, and now expanding to include others, they're actively working on alternatives to the dollar-dominated system. And while gold gets most of the attention in these discussions, silver is quietly playing a role too. China, in particular, has been accumulating silver for years. Their strategic reserves are opaque, but industry estimates suggest they've been net importers of significant quantities. Why would China be stockpiling silver? Because they understand that in a world where supply chains are critical and industrial capacity is power, having control over essential commodities is strategic. Silver isn't just money, it's a critical input for technology, defense systems, and green energy infrastructure. Russia, facing sanctions and looking to diversify away from dollar assets, has been increasing its precious metals reserves. They're one of the world's largest silver producers, and they're keeping more of their production domestic, rather than exporting it. When major producing countries start hoarding their own output, that's a signal that something significant is shifting. Let's talk about the technical picture for a moment, because the charts are telling a story that aligns perfectly with these fundamentals. Silver has been consolidating in a range for the past year, building energy like a coiled spring. We've tested the upper boundary of this range multiple times, and each test has been met with strong buying. The moving averages are converging, volatility is compressing, and we're seeing classic accumulation patterns that typically precede major breakouts. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been hovering in the high 70s to low 80s. Historically, this ratio has averaged somewhere in the 50s to 60s range. When it gets stretched to these levels, it tends to snap back violently, and when it does, silver dramatically outperforms gold. We saw this in 2020 when the ratio hit 120, and then silver rallied over 100% in the following months, while gold gained about 25%. If we're heading into a precious metals bull market, and all signs suggest we are, silver is positioned to be the leverage play. It's more volatile than gold, which means bigger percentage moves in both directions. But when the trend is in your favor, that volatility becomes your friend. A 20% move in gold often translates to a 40 or 50% move in silver. Here's something else that's flying under the radar. The silver mining stocks, the companies that actually pull this metal out of the ground, are trading at valuations that are historically cheap relative to the metal price. We're talking about price-to-earnings ratios and price-to-cash flow metrics that are at decade lows. When silver starts to move, these stocks typically leverage that move by a factor of 2 to 3 times. A 10% rise in silver can translate to a 20 or 30% gain in well-positioned mining stocks. But here's the thing about mining stocks. They're not for everyone. They come with operational risks, management risks, geopolitical risks if they're operating in unstable jurisdictions. The physical metal doesn't have those risks. It just sits there, holding its value, waiting for the market to recognize what it's worth. That's why so many sophisticated investors are choosing to hold physical silver directly, either in allocated storage or in their own possession. Let me share another story that drives this point home. In 2008, during the financial crisis, there was a brief moment when silver dropped below $9 an ounce. People were panicking, selling everything. But a small group of investors who understood the fundamentals backed up the truck and bought as much physical silver as they could get their hands on. By 2011, silver was trading at $48. Those investors who had the conviction to buy physical metal when everyone else was scared made life-changing returns. Now, I'm not saying we're in a 2008 scenario. The setup today is completely different, but the principle is the same. When you have a hard asset that's fundamentally undervalued, trading below its cost of production, with surging demand and constrained supply, and you can buy it at prices that don't reflect that reality, you're looking at an asymmetric opportunity. The monetary side of the silver equation is also heating up. With inflation proving to be far more persistent than central banks anticipated, people are looking for stores of value that can't be printed into oblivion. Gold has always been the go-to monetary metal, but silver has a 5,000-year history as money too. It's been used as currency by more civilizations than gold has, and at current prices, it's far more accessible to average investors than gold. Think about it this way. An ounce of gold costs over $2,000. That's a significant chunk of capital for most people. But an ounce of silver is in the $25 to $35 range, depending on the form. You can start building a position with a few $100s. That accessibility is driving retail demand globally, especially in countries where people have experienced currency devaluation firsthand. India, one of the world's largest consumers of precious metals, has seen silver imports surge. Indian households have traditionally favored gold, but silver is gaining traction as a more affordable way to preserve wealth. When you have a population of over 1 billion people, even a small shift in preference can move markets. And we're seeing that shift happen in real time. The investment demand picture is also evolving. Silver ETFs, exchange-traded funds that hold physical silver, have seen inflows picking up after a period of outflows. When institutional money starts flowing back into these vehicles, it creates buying pressure that has to be satisfied with physical metal. The funds have to go into the market and purchase actual silver to back the shares they're issuing. That's real demand, hitting a market that's already tight. But here's where it gets really interesting. There's a growing awareness among investors that not all silver holdings are created equal. The difference between owning shares in an ETF and owning physical metal in your possession is becoming more apparent. ETFs are convenient, liquid, easy to trade, but they're also paper claims on metal that's held by a custodian. In a real crisis, in a scenario where the financial system is under stress, those paper claims might not be as solid as you think. Physical silver, on the other hand, is tangible. It's in your hand, in your safe, in allocated storage with your name on it. There's no counterparty risk, no custodian that could potentially have issues, no fine print in a prospectus that might limit your ability to redeem. It's just you and the metal. And in uncertain times, that certainty has value. We're also seeing a generational shift in how people think about wealth preservation. Younger investors who grew up in the digital age are surprisingly interested in physical assets. They've watched Bitcoin and cryptocurrencies boom and bust. They've seen how quickly digital wealth can evaporate. And many of them are coming to the conclusion that having some portion of their wealth in tangible, physical form makes sense. Silver, with its lower price point and dual role as both money and industrial commodity, appeals to this demographic. The supply chain disruptions of the past few years have also changed how companies think about critical materials. Just-in-time inventory management, which was the standard for decades, has given way to just-in-case stockpiling. Companies that use silver in their manufacturing processes are building larger inventories to ensure they don't get caught short. That's additional demand that's structural, not cyclical. It's not going away when the economy slows down. Let's talk about what a breakout could actually look like. If silver clears the resistance level it's been testing, the next significant level is up around $38 to $40. That's a move of 25 to 35% from current levels. But if the fundamentals I've been describing really start to play out, if we see a genuine supply squeeze combined with surging investment demand, $40 might just be a waypoint on the journey to much higher.